Thanks for checking in. Steve Kalem. I wanted to talk about today's market and the competitiveness and anxiety that it provokes in today's market, and how to address something which is maybe near and dear to everybody's heart, the anxiety over buying a home with escalating prices. So, as you know, we only have so much inventory, and that's getting tighter and tighter actually, and we have an incredible amount of qualified, hopeful home buyers. So you have a competitive situation in many of the desirable areas that are continuously going on. That results oftentimes in competitive bidding up of the price of the home. So oftentimes these are all cash offers, and it's incredible that you see every day these things, but many times people are getting loans, and part of accepting the offer is the listing agent and the seller being able to be comfortable that the buyer is going to be able to qualify if the appraisal comes in low, or they have the cash to cover, is what they typically call it. Also, people who set aside the money to buy their home, they set aside a certain amount of money, and it's very, very painful to come up with significantly more money, maybe to buy that home when you've thought about it, planned for it, and there you see it all in front of you. So you don't really have to cover the full amount. There's many ways of addressing it if you know what you're doing. And let me share my screen with a situation that just happened. And this happened in June. And at the end of June, as you see, situation where the people bought the house for $1 million. This is a house, these people worked very, very hard, very long hours to save money to buy a home in a specific area of Maryland to raise their family. And they finally saw the home. They know the rates were right. Everything was great. It was a competitive situation. They ended up buying the home for $1 million. And lo and behold, the home appraised for $900,000. They had to come up with the $100,000 difference. They were putting 20% down on $1 million. They thought they had to come up with a $100,000 difference to cover. And it was a very, very anxiety-provoking situation. But we were able to handle this in an almost invisible manner to the buyers. So let's take a look at how we do that in a variety of situations. I have to my left 3 vertical columns. The first column on the left is exactly the way the contractor is written, the way everybody had hoped it would go. $1 million purchase, 20% down, 80% loan is $800,000. The rate at the time for a 30-year fix was 2.79. There you see the payment and the cash to close, which was the down payment of $200,000. 20% on $1 million, and the closing cost, a little bit more than $231,000. Now, the property actually appraised for $900,000, but before we get there, let's just look at the increments, because this is the way to evaluate this when you're making an offer on a home where you're doing an escalation. If it appraised for, say, $950,000, again, the banks all will lend off the appraised value or the purchase price, whichever is lower. The collateral for the loan is the property, and if the property is valued at this amount, that's what they're going to lend off of to make it a risk, to assess the risk, let's say, of the loan. So in the 950 case, we're going to lend off $950,000. Well, the buyer is buying off $1 million and putting 20% down. That's $200,000. Well, that's an $800,000 loan. We want an $800,000 loan on a $950 purchase. That's about a little bit less than an 85% loan. So consequently, there is typically a component called mortgage insurance that you can do the same thing, but we have a great program which has no mortgage insurance if you meet all the thresholds, which most people do. And it really doesn't impact the rate at all. So let's take a look at it. The rate went from 2.79 to 2.85, not because of the mortgage insurance. There was no mortgage insurance. It's because the exposure to the bank went from 80% loan, 800 on $1 million, to 85% loan, 800 on 950. So that's risk to the bank. So it's 2.85, slightly higher interest rate. But look at how it affected the monthly payment. Nominal, $26, I think, a month. And how did it affect cash to close? Nominal, a couple $100. I probably made a mistake. It should be the same. Okay. If it appraised for 900 like it actually did, then here you go, same exact situation. They're still borrowing 800 on 900. The rate is a little bit higher because it's higher exposure, and the payment is higher, $42.76. It's $69 more a month, but the cash to close is about the same. So it's fantastic. These people were extremely happy. I'll click here so you can see how it works. You see that these are the three scenarios, and it's a purchase price of $1 million regardless. The principal and interest payment goes up as the interest rate goes up slightly and the loan amount goes up fairly significantly. That's what's changing. The payment of taxes and insurance are staying the same because it's the same value that you bought the house for. Now, if you're doing this with mortgage insurance, I can do the same thing. There's a couple different ways to address the mortgage insurance where your payment would increase monthly, or you have a one-time fee, which you buy out the mortgage insurance for the life of the loan. And in a case like this, it might be $8,000 or so, but you are certainly not coming up with $800,000 or $100,000. And because of the way the systems are working with exposure to the bank when you have mortgage insurance, I can typically cover that because of with a lender credit. So the exposure to you, to a buyer, is minimal with a lender credit and the monthly payment. We walk through all of that. So hopefully this was all helpful. Please give me feedback on if it was. And thank you. Thank you so much for checking in. And if I can close this thing, I'll be very happy. Pause, stop, and have a great day.